I think tech is really interesting and important to look at in two ways. There are the infinite multiple tech stocks, and then there are plenty that have really, really tame, really reasonable PE multiples, like Qualcomm, like Seagate, like Microsoft, like IBM. So I think you need to look at it both ways. And I think you need to pay attention to that tech is not all just the high flyers. There's still a lot to do.
Josh?
Yeah, I think that's reasonable. Look, a lot of this conversation, a lot of the way you would view this topic would be through the lens of what you do. So if you're a value manager, you can find a lot of high-quality technology companies trading at reasonable multiples, both on an absolute basis, on a historic basis, and relative to other segments within the S&P. There are no shortage. A lot of the market, though, currently, and a lot of the interest in the media currently around tech stocks is being driven by the higher multiple names. And in many cases, the higher multiple names have had those multiples justified repeatedly, year in, year out. And we can go down the list, and I won't do it, but just one very specific example. Any company engaged in software as a service, these are companies that have 30% profit margins in businesses that are growing 50%. It's ridiculous. There's never been anything like this before in the history of corporate America.
Ridiculous, like this is so good, let's have more. Well, or ridiculous, like wow, I can't get this is not sustainable.
Ridiculous, like these are businesses that are every bit as dominant as, let's say, the railroad boom 100 years ago, and then electricity, and then all of these big waves of innovation. The difference is the cost of doing business is so low. The ability for companies to build on top of other people's platforms and just have these multi-billion-dollar products appear out of nowhere. And a lot of them aren't even public yet. You think about a company like Slack, would not have been possible without the ability to utilize things like AWS and Google's cloud and Microsoft's cloud. That's a business that could grow 50%, 100% for its first 5 years and then settle out to a low growth rate of 30% a year. This is inconceivable when you think about how quick they can grow, how profitable they could be, and how little upfront investment is required because of the platforms that have already been put in place by broadband companies, by cloud computing companies. So I think it's important to not get overly caught up in backward-looking PE ratios, because that can be a recipe to find a lot of value traps when you're trying to find value. And I think we've seen that with some very high-profile managers repeatedly throughout the post-crisis era.
I think what's interesting is tech had its worst week since March, and we're reflecting back on what happened 10 years ago. And I think what we're doing is, when we're saying that technology had its worst week since March, we're thinking through the same psychological lens of 10 years ago. And really, subconsciously, what are you asking? You're saying, is the technology move completely over? And I don't believe anyone fundamentally can provide the evidence to suggest that that's the case.
That's not what I was saying.
I think more importantly, what has gone on here is that August was an incredibly strong month for technology, where you had the confluence of strong earnings, momentum players, and strong buybacks acting as a catalyst in the technology space. And here in the beginning of the month of September, you're seeing allocations towards technology rightfully being pared back, losing some momentum, and now we're entering a period where, first of all, 2018 is going to be a historic year for buybacks. Well, the next couple of weeks, you're going to be absent of those buybacks ahead of the earnings season.